With no further ado, though, I want to introduce author who's going to go into some recent Medicaid changes and some elder law issues that have occurred recently. And with that, take it away.
Thank you, Neil. I'm going to share my screen with you guys, share my PowerPoint presentation. So one of the main things that has happened during the last couple of months, and as a byproduct of somewhat of an extent, a byproduct of the COVID-19 crisis, was there are a lot of changes that are coming to the Medicaid program, and that affects many of us in terms of who represent clients and who are worried about long-term care costs and Medicaid, programs that we're going to be talking about and using possibly in the future. So a lot of what I'm going to talk about today is going to deal with those Medicaid program changes that came down from New York State, came down from the governor's office with the budget. So just so you have it up here, this is my bio. I'm an attorney. I've had my own firm since 2018. I've been an attorney since 2014, exclusively doing elder law and estate planning, and I am a member of New York State and Suffolk County Bar Associations. So what I'm going to talk about today is briefly, I'm going to go over what the Medicaid programs that are changing and have been affected by the recent budget changes from New York State. I'm going to briefly explain what they are so everybody has a good understanding, which really we're going to talk about community Medicaid and chronic care Medicaid. We're going to talk about how do we plan for those programs, how do we get onto them, how do we apply, how we transfer assets to get eligible for those programs, and what those asset transfers do to our eligibility. And then I'm going to talk about the changes that are coming down the pike. What does this mean for our financial plans that we've put in place, the estate plans we've already put in place, tax planning, all of our retirement accounts, insurance we have, what does it mean for our real estate, et cetera, et cetera. And what that means basically, the conclusion is that we have to plan, and planning is going to look a lot uglier than it did before. And it's going to be more difficult, but it's going to be much more necessary than it was before. And I'm briefly going to mention a lot of the changes that came to estate planning during the COVID-19 state of emergency here in New York. We're going to talk about how remote estate planning would work. So briefly, the two Medicaid programs that we deal with here in New York State for elderly individuals who need assistance in their home or need nursing home care are community Medicaid and chronic care Medicaid. So what are they? Well, community Medicaid typically provides at-home care services for individuals who are unable to perform what they call activities of daily living, such as getting dressed, getting in and out of bed, going to the bathroom, showering, bathing, feeding themselves, those sorts of activities. Individuals who need assistance with those activities would then need some sort of assistance from an agency, from an aid. And so that's where community Medicaid can come in and assist you with that and assist you in paying for that program. Now, you apply through your local Department of Social Services for this. Hopefully you hire an attorney to help you with this. I recommend it for almost everybody because it's not an easy application process. It's very in-depth, requires financial records, requires a very complicated and sometimes redundant application, and you have to know how the system works and where everything's supposed to go. One of the programs I want to mention that ties into community Medicaid that you may have heard of is called the CDPAP program. It stands for the Consumer Directed Personal Assistance Program. Now, this program basically, in a nutshell, allows individuals who are not aides that are employed by an agency to be paid by Medicaid as long as you're on community Medicaid. You can have these individuals who are somebody you get from your local church, your local synagogue, your senior citizen center, your neighbor, even a family member. You're able to get them paid for the hours that Medicaid otherwise would cover through an agency. So it's a great program because there's familiarity, and especially with Alzheimer's and dementia patients, this is a really great thing. Chronic care Medicaid is a little more straightforward. It provides, that Medicaid program provides coverage in a skilled nursing facility. Typically it arises, and the need arises when an individual cannot go home after they've gone into a nursing home for rehabilitation services, and now they need to stay in that nursing home for a longer period of time. And they're no longer a rehab patient, they're a long-term patient. And thus, Medicare will not cover those days and that stay in the nursing home. So now you need to pay for that, and that's where chronic care Medicaid comes in. I want to note that this doesn't cover assisted living facilities. It's important that people understand that there's a difference between skilled nursing facilities and assisted living facilities in those communities. So, moving on, qualifying for community Medicaid. So, in a nutshell, and I don't want to get too bogged down in this, there is an asset and an income financial snapshot test that is done in the month in which you apply for community Medicaid. So when you are applying, you're just going to have to provide bank records, proof of what kind of income you have as an individual, and you will either qualify or you won't qualify based upon those records. Now, as you can see, the limit is $15,750 for your countable resources, your certain types of assets. For income, the limit is $875 a month. Now, those are not, there's a lot more nuance to that. If you make more than that income limit, you can still qualify using something called a pooled income trust. And obviously, if you have more than $15,000 in your name, you can transfer it out of your name, and you are now below that limit. You can take, if you have $20,000 in a bank account, you can take 10 out, give it to somebody else, give it to a child, give it to a trust. Typically are things that we would talk about doing, and now you are eligible. You have met the resource test. For chronic care Medicaid, it's the same asset resource test as for $15,750. The income is a little more straightforward. You get to keep $50 of your own income, and the rest goes to the nursing home, basically as a down payment every month. It's a little more harsh, obviously, but you're getting, something that is worth $12,000 to $15,000 or more a month of health costs covered by the state. So the least you could do is give your income, as I try to explain to many clients. So that leaves us with, okay, what happens if I have more than those numbers and I have more than that amount of money in my name? How do I qualify? Well, we transfer assets out of our name, as I mentioned. Now, a lot of you may have heard of something called the 5-year look back. And then without getting too bogged down in it, the 5-year look back essentially says that from the preceding 5 years from when you apply for chronic care Medicaid, now this just deals with the nursing home, for every transfer, every gift, every uncompensated transfer, they call it, meaning you wrote $10,000 and you gave it to a child for nothing in exchange, or you transferred it to a trust. For every dollar you transfer, that during that 5-year period prior to when you apply, Medicaid will count up all of those dollars that you transferred. And if it's real estate, they're going to ask for a value of the real estate, and they're going to come up with a cumulative number, and they're going to come up with a penalty number. That's going to cause a penalty, which means you have to pay for the nursing home privately during a certain period of time. What is the calculation? Well, the more money you transfer out of your name during that period of time, the longer that penalty period is. Now, I don't want to get down to the calculation because it goes down to months and days, but what you should understand is that during the 5 years prior to going to a nursing home, if you made transfers to get yourself eligible, Medicaid will give you a penalty, will assess you a penalty as an applicant, and you'll have to pay for months and months and maybe even years, depending on how much you transferred, before Medicaid actually picks up the bill. And that obviously can get very expensive very quickly. So planning in advance becomes very important. Now, in these situations, typically when you hire an attorney to do those kinds of transfers, that's where trust planning is typically more involved and where it happens more frequently. But sometimes you can use individual family members, as I mentioned. But that begs the question, what about community Medicaid? What about transferring to qualify for community Medicaid? Well, up until now, for community Medicaid, you could transfer assets today, and if you got under that limit, you would be qualified for the next month, May 1st. So if everything was done as of today, April 30th, May 1st, you're eligible for Medicaid, for community Medicaid, with no penalty. That is until now. With the new budget changes that have occurred, the governor and the legislator in their infinite wisdom have now created a 2.5-year look back for community Medicaid where none existed before. So that means when you apply for community Medicaid, you're going to have to give 30 months of records, not 60 like with a nursing home application, but you're still going to be now subject to a similar kind of penalty. And so the more money you gave away during the 2.5 years prior to when you apply, the greater of a penalty coverage that's going to exist. Now, there's a lot of questions that come into play. The first one and a lot of these we don't have answers to, unfortunately, and that's the frustrating part for us as attorneys. You know, I was on a webinar with the Elder Law Committee for the New York State Bar Association last week, and we were talking about these issues. And so I am disseminating a lot of the answers I've gotten from the people who were lobbying the legislator in Albany last month or this past month, and back in March and February and January. And so what we don't know are things like whether or not transferring a house out of your name during that 2.5 years will incur a penalty. We don't know if there's going to be some sort of retroactive, grandfathering in of coverage, because the last time a change like this happened, it was 2005. And so in 2005, they increased the look back for nursing home Medicaid from 3 years to 5 years. But they said that no transfer that happened prior to that change in the rule would be counted towards that penalty, that new 5-year look back rule penalty. You would still only be subject to the 3-year look back rule penalty, which was a nice, fair thing to do. It said, well, I didn't know what the rules were when I made my plan. Don't go back and penalize me for not knowing a change that didn't come yet. And that's the same sort of situation here. And that's some of the same frustrations that we are facing now, is that we need the Department of Health, which we know is busy right now with something called the COVID-19 epidemic, but we need answers from the Department of Health in terms of clarification for this. So I say that this is the ugly part of it. Now, that's not the only thing. There are other bad changes that are coming down the pike as well. And these are changes are going to be happening as of October of this year, which doesn't leave us a lot of time, considering that we have to do a lot of estate planning remotely as it is. It doesn't leave us a lot of time to plan for the clients who already have plans in place or who don't even know about this. The CDPAP program is changing. Without getting too nitty gritty, there are entities called fiscal intermediaries, which are assigned by the state, and those fiscal intermediaries, a lot of them are going to be going away, and the rules are going to be changing about who can be a fiscal intermediary. And so those are the people that essentially allow the CDPAP program to exist as it is. And so again, clarification needed, but we know that limitations to the program are coming. Changes to assessments. This is another big thing that's going to happen. So typically after you apply for Medicaid, you then have to have a nurse come to the person's house to assess whether or not they need these Medicaid services, which it's a low bar. You kind of know as a practitioner, you meet somebody, you kind of obviously start to know who needs it, who doesn't. And the second assessment is for how many hours a day and what type of coverage and what type of assistance the aides are to provide. That's the other assessment that occurs. It used to be that your own doctor would be the one that would ultimately come up with the assessment of whether you needed services and would give a factual sort of, fill out form and fill out, say, this is what my individual patient needs. Now, one of the changes is that the state is going to appoint a doctor to make that determination of the level of need. And this is important because they call it a disability determination, but it's not the same as SSI disability. I want that to be understood. But this disability determination that is done by a person's own doctor, this is now going to be done by a state-appointed doctor who doesn't know the patient. And so that is needed to use a pooled income trust. And so that's going to slow down the process even more. And that's going to make this a lot harder. One of the things that is striking me with a lot of these changes, and I do want to take a step back and make a pause and make a comment, is that one of the things that it's showing us as an elder law community of practitioners and attorneys is that ultimately you as an individual or your clients are going to have to come up with alternative methods other than relying just on Medicaid. You know, Medicaid as a program is a great program. It is a welfare program, but it is a great program that exists for individuals to pay for very expensive long-term care costs, be it at home, in an assisted living facility, or in a nursing home. You know, those long-term care costs are very expensive. But it's what we're seeing is that the program is being limited and scaled back because of money and budgetary issues. And so what's happening is that you are not going to want to rely on this program or these programs as your sole method of protecting yourself and covering yourself for these expenses. Talking to someone like Rhonda and making sure that you have long-term care insurance and have that in place as early on in your life as you can is very important. Talking to your accountant, someone like Nichole, and making sure that not only do you have your tax documents done, but that you're making decisions about your financial plan that are most tax advantageous, because, you know, there are a lot of changes coming that are outside my scope. And ultimately, you need to make sure that you have as much savings as you can, especially when these kind of changes and these kind of needs come up. One of the things about that new doctor that I forgot to mention, that Data Point doctor, is that with their new assessment tool power that they'll have, it's unclear on whether or not they will be able to recommend or not allow somebody to use the CDPAP program, because one of the things that the law mentions, and that some of the attorneys that I've spoken to have mentioned, is that it's unclear whether or not this doctor can sort of turn around and say, oh, they need more than just, you know, basic CDPAP level care. They need someone skilled, someone certified to be a nurse, so something more than a home health aide. So that's, again, a lot of unclarity, but it's showing us that we need to make sure that we're ahead of the curve and that we're planning for this. The last big change that I want to mention is with the assessments. With more things with the assessments, they're getting more strict as to how they assess individuals. It used to be that you only had to not be able to perform, you had to be unable to perform one activity of daily living normally, whatever that means. It was not very clear to begin with, but it was only one activity of daily living, and they had a list of 8 for 120 or more consecutive days. So for 4 months or longer, you're unable as an individual to get out of bed, to go to the bathroom by yourself. You need somebody to help you do that. Any one of those activities, you were qualified for these services. Now, they have changed it. If you are somebody who does not have Alzheimer's or a dementia diagnosis, 3 or more ADL limitations need to exist. Not 1, but 3. If you are somebody who has been diagnosed with Alzheimer's or dementia, or has dementia symptoms, you need 2 or more ADL limitations. They clarified how do you define the limitation, and they have a score sheet now and everything, so, which is good. It's better. It's the assessments themselves are going to be more objective, but the amount of disability somebody has to have, the amount of limitation someone has to have, is now increasing significantly. And so it's just going to further limit the number of people that are going to be on this program, who are going to be eligible to get anything significant in terms of a number of hours, 6, 8, 12 hours a day. So I have one tidbit of good news. I have 2 tidbits of good news. The good news that came out of these budget changes, we were worried as a community about spousal refusal and spousal exempt transfers being eliminated or limited, and neither of them were, which is good. The long and short of it is that spousal refusal and spousal exempt transfers basically say that if an applicant is married and has a spouse, the spouse's income and the spouse's resources do not count towards eligibility for Medicaid, especially community Medicaid. And there are some transfers to a spouse that are exempt, that do not incur a penalty, that can be done, and each individual person's situation is different. At least $74,000 can be transferred, up to $128,000. There's math that's involved, and that number goes up slightly every year. But those are left intact, which is good, which helps us, because most states have eliminated spousal refusal at this point, but New York and Florida, I believe, still have it. So now what? What do we do? So the need for planning is greater. And I mentioned before, and I will mention it again, I will hammer this home as long as I can. You have to speak to professionals, and you have to make sure that your plan, both on the estate planning side, on the tax planning side, and on the financial planning side, are all working together. And that's why it's really beneficial, especially, and I mean, listen, I think, Rhonda and Neil and Nichole are great. I think they're all fantastic, and I love working with them. And I think, they keep up to date with everything. And I mean this genuinely, and they are on top of this. I mean, this is coming down the pike in the last couple of weeks. This is brand new. And so we're trying to disseminate this information now to as many people as we can, because we think it's important that our clients and our colleagues are on top of this and know what's going on. And so you have to really work with us as a team. And I think it's important that you understand we work as a team. And if you work with us, you're not just getting me, you're getting everybody else too, and vice versa. Doing trust planning with your estate planning, making sure your estate plans that I did with my own clients. I am now currently reaching out to my own clients and saying, hey, we made a plan 6 months ago, 9 months ago, 2 years ago, 3 years ago. We got to amend that now. We got to revisit that to see if what we did is going to still work. And it may in certain instances be fine, but in a lot of cases it's not. I'm going to have to make changes to a lot of my clients' plans because they're not going to be appropriate anymore under the new rules. Tax planning, and I'm going to let Nichole obviously talk about this, but the Secure Act and the CARES Act have made a lot of tax law changes. And so, you got to keep up to date with these. These are things that you may want to amend previous year's returns. I mean, that's the level we're getting to. And obviously with financial planning, making sure your insurance and your financial plan is correct, intact, and is up to date with the new environment we're living in. The earth is moving beneath our feet, as Neil said. And so, what do we do in today's day and age? It's planning. You just got to keep talking to the professionals, keep talking to us, and we will guide you as best as we can, and making sure that your plan is up to date. Now, for my piece now, what's topical now is during COVID-19. I'm sure many of you have heard of this, at least somewhat. There are executive orders that came down from the governor last month, 202.7 and 202.14, that allow me as an attorney and a notary to remotely notarize documents and to perform estate planning consultations, will executions, trust document executions, powers of attorney, healthcare proxies, deeds, all the documents that typically are used when you make an estate plan and you tweak your estate plan and you make it beefy or whatever you want to do. All of those functions can now be done in this format, literally, where we have witnesses to those documents and notaries to those documents, all virtual, all on telecommunication devices. So, I mean, listen, it's there's no excuse, and there's no reason you can't do it. And we are here, as you can see, we are using this technology, and we are ready to assist our clients with all of these needs. And as far as I can tell, and I wish this weren't the case, as far as I can tell, these laws and these changes and these remote notarization and remote witnessing will be in effect until the state of emergency is over. I have a sneaking suspicion that at some point these measures are going to be made more permanent. So here's my contact info. That's really all I have to say on my end. If you need me, there's my email and my phone number, and I'll throw it back to Neil. Neil, you're muted. Unmute yourself. Neil, you're still muted.
Sorry about that. Just to add a couple things, thank you so much, Arthur. That was a terrific presentation. Two things that you need to know that are very important as far as the legal end. Everyone should have their healthcare proxy up to date with this COVID-19. If you're single, particularly, or if you're a widower or your parents, that stuff needs to be up to date. In addition, there's now burial directives you can do. There's a bunch of legal things that you should be planning on and doing today if they're not intact.
Neil, can I just jump in with that?
Sure.
Typically in my healthcare proxies, I have somebody appoint a burial agent. So it's, again, it saves you from extra paper, but that's
Right.
part of the deal.
No, I get it. The idea is with COVID-19, issues are coming up that we never expected. And with that in mind, planning is so important that not only you look for yourself, but your parents and your children, and you want to make sure everybody's intact and everything goes the way everybody needs to go. And with no further ado, I want to have Nichole. Is she still here? Ah, you're there. Okay.
I'm
She
here.
popped
Yeah.
out and popped in for a second.
Yeah,
Nichole,
Zoom kind of froze on me, so I had no other choice.
right. Nichole's an enrolled agent and has been working on tax returns, and she's been so busy with this CARES Act that it's just been insane with all the stuff that's coming down. So if you could, Nichole, and introduce yourself and talk about that.
Sure. So my name is Nichole Hyde. I'm an enrolled agent and accountant with Rosedale Trapala CPAs and CPA Tax Partners. We are two firms. I'm going to share my screen. Okay. Great. So today I'm just really going to talk about a few things, basic stuff. There's a lot of information going out there. Again, I'm with Rosedale Trapala, CPA Tax Partners. Rosedale Trapala is your local CPA firm. We're based in Montauk. We do assurance, accounting, taxation, and business consulting. CPA Tax Partners is a remote national firm offering accounting and taxation and consulting services in all 50 states. A little bit about me. I've been doing this for 14 plus years. I work with a lot of different industries. Some highlights about 2020 is that I've saved $26,000 in taxes for one client by drafting a relocation plan. I won a New York State residency audit, and all the clients that enlisted my help or accepted my help for PPP, I was able to get them funded, six-figure funding in the first round of loans. So a couple cool things. So webinar topics today, we're going to talk about the CARES Act, the Family First Coronavirus Response Act, and just for our New York State attendees, the pandemic unemployment assistance, because there is some miscommunication about that. So under the CARES Act, the tax deadline has been extended. So the original deadline was April 15th, and this includes tax payments that would have been due on April. They have been pushed back to July 15th. If you need an extension past that, you do need to consult with your tax advisor, CPA enrolled agent, for them to prepare an extension for October. If you are working with Arthur or Rhonda, and you're doing gift taxes or gift planning or generation skipping, those returns have now also been pushed back to July 15th. If you need any additional extensions on it, they need to be filed. So a couple of things with clients throughout the United States. Some states have already started to receiving the economic impact payments. Some clients in New York have not. So I just kind of want to run through the eligibility requirements real quick, because there seems to be a lot of confusion about whether clients or taxpayers will be receiving these funds. So, and this is under the CARES Act, and it's basically kind of a stimulus payment just to kind of help everyone get by for the next couple weeks. The eligibility is individuals need to be a U.S. citizen, a permanent resident, or a qualifying resident alien must have a social security number. An individual cannot be claimed as a dependent on another person's tax return. So this comes in if you have a college student, or if you have someone that's being claimed as a dependent because they're on SSDI, they won't be able to get their own economic stimulus payment. The adjusted gross income for filing status needs to be under $75,000 with a complete phase out of $99,000. So what does that basically mean? It means if you earn $75,000 and less, you'll be entitled to the full $1,200 amount. If it's between $75,000 and $99,000, it's going to be a prorated amount, and there's a phase out of 5% that caps total complete phase out $99,000. For married filing joint, it's $150,000. The Treasury Department just took 75 plus 75 and came up with the 150 for two people. That one was pretty straightforward. Individuals will receive $1,200. Two individuals or married couples or domestic partnerships will receive $2,400, an additional $500 per qualifying child. This is important. They do need to be a child. Economic tax payments for non-filers. If you were not required to file your federal tax return for 2018 and 2019, you can still qualify. There is a website, and I've listed it below, and I'm happy to put it in the chat box, that you can go and fill out your direct deposit information, and it'll automatically update. There's also a link, which I'll include in the chat box, where you can check to see where they are in processing your payment, kind of like the where's my refund for the stimulus payment, to see if they're at that point with processing. One of the best things I think to come out of the CARES Act, besides the PPP loans and the EIDL, is this, because the government realizes that families especially are going to be impacted by this. They're going to need access to funds. So what they were able to do is they were able to say, you know what, families more than likely working with Rhonda, they're going to probably ask the question, can we borrow down? Can we take distributions or loans from our 401k or qualified retirement plans to help fund payments to keep us afloat, right? And the government through the CARES Act said, you can do this, and not only can you do this, we're going to waive the 10% penalty for early withdrawal, which is fantastic because a lot of times they do. And they did some additional things. The eligible distributions can exceed $100,000. They're not subject to the 10% penalty withdrawal. And also, you can actually spread out the tax over 3 years. So now for some reason, for tax planning purposes, we might determine that maybe that doesn't make sense. We're going to pay the tax on the distributions in year 1 opposed to spreading it out. We'll make an election to do that. But for families who are trying to get by and trying to balance the tax burden of making this withdrawal, we have the option of spreading it out ratably over 3 years, which is pretty considerate of the government. They don't usually do things like this. This one was definitely a surprise. The Family First Coronavirus Response Act was basically a way for the government to help protect the employees in this sort of situation. It was created in response to COVID-19. And this is, you know, a bit in the news, so this might be a refresher for some of you, but it doesn't hurt to go over it because I still hear that there are employers who are not adhering to this yet. Employers with less than 500 employees are required to adhere to the new federal law. There is a 30-day good faith compliance temporary, which started on April 1st. So from April 1st, they have 30 days to comply with this law. So by April 30th, which is basically today, they are supposed to be in a window of compliance. The U.S. Department of Labor will help nonprofits and small businesses implement this new law, which protects employees. So employees qualify for leave if they're unable to work, including telework, due to COVID-19 qualified reasons. So some reasons for qualified leave would be subject to federal, state, local quarantine, isolation, or other related COVID-19. So basically every state now has a pause or some sort of stop work order. Has been advised by healthcare providers to self-quarantine due to COVID-19. Is experiencing COVID-19 symptoms and seeking a medical diagnosis. So maybe you feel sick, you're on your way to get tested, you're not really sure, your doctor tells you to self-quarantine, this would be covered under that. Is caring for an individual subject to an order described in self-quarantine as number 2. Okay, so basically that's when you're caring for your child or caring for a family member, caring for a child whose school or place of education is closed, or any other health, Department of Health or government-related closure would fall under this. So what's covered? So if you're working full-time, 2 weeks up to 80 hours of paid sick leave at the employer's regular rate of pay, if any of the below apply, you're unable to work due to quarantine, or unable to work due to the advice of a healthcare provider, or you're experiencing COVID-19 symptoms. So that means if your business is running, you should get 2 weeks of pay up to 80 hours. So the difference is that I found that some employees only work 35 hours. That's considered full-time at their place of employment. So then they would get 70 hours. Okay, so now if you're required to take leave to care for a sick child, you're still able to get 2 weeks up to 80 hours of paid sick leave, up to 2/3 of your regular pay rate. And that's again, if any of the below apply, quarantine, advice of a healthcare worker, symptoms, or school child daycare is closed. Now, if it extends, you can get up to additional 10 weeks of paid family medical leave at 2/3 of the employee's regular rate of pay if it's a bona fide need to leave for a child, to care for a child. But in order to get this, you have to be employed for at least 30 days before the claim. So previously, the way that the Department of Labor had said, well, even if the employee starts for you like 2 days before COVID-19, they still fall under this rule for the 80 hours or the 2/3 of 80 hours. Now, to get the 10 weeks, they have to at least be employed 30 days prior to it. So that's kind of a big help with a lot of people. And I don't think a lot of individuals and families are still aware of these. And I don't know if the employers are aware of this either, because I'm still fielding a lot of phone calls on these different HR/how do I pay my employee questions. So the payment calculations get a little tricky because there is a cap, right? So for leave reasons 1, 2, or 3, which is basically I'm sick, I have symptoms, or self-imposed isolation, you're entitled to your regular rate of pay or the applicable minimum wage, whatever is higher, up to $511 per day over the 2-week period. Now, if it's 4 or 6, basically taking a leave to take care of a sick child due to their school or place of education closing, it's 2/3 or $200 per day, $2,000 aggregate over a 2-week period. And reason 5, the 10 weeks, that's again 2/3, $200 per day, $12,000 aggregate over the 12-week period. Some exemptions are if you have a small business and there's fewer than 50 employees, this may not apply. Another question that I've been getting a lot from just people who I do individual tax work for is that they don't understand the difference between termination and a furlough. And this kind of falls into this a little bit because with 50 employees, they're not considered a large employer. So I'm going to circle back and touch on that because that's kind of important to people that may not understand. But if you are self-employed or you do have a few employees under you, this exemption needs to be in place prior. It should have been actually already documented. And you have to have actual paper documentation saying that you're paying employees and challenges viability to the nonprofit or the business. And that basically means that, hey, if I have to do this, I'm going to go bankrupt. My business is going to go bankrupt. We're going to go under, right? So be aware that not all employers are going to do this. They might have an exemption, but it's definitely worth talking to your HR department about, or your boss, or whoever your supervisor is. That's just for the businesses. This is another thing where we're still getting questions for. The New York State Pandemic Unemployment Assistance, who is covered. So basically, everyone that was furloughed or terminated is under coverage for this. And it includes a few additional not normally included groups. So if you're self-employed, independent contractors, gig-based app workers, so if you're on Upwork, freelance, Fiverr, any of those type, drivers for Uber, Grubhub type apps, and you're being not able to work, you can qualify for the PUA or Pandemic Employment Assistance. Also farmers and anyone affected by COVID-19. There's a great handout, which I'm going to include in the chat box as well. And what this is that you get an additional $600 per week in addition to your regular UI benefits, which cap out at $504.11. And it's guaranteed through July 31st, 2020. As of right now, I haven't heard if they're going to extend that or not. They may not. So it's definitely something to consider if you do have the ability to return to work. Just keep that in mind that as of July 31st, that $600 benefit will expire and you will see a cut and you might need to make other arrangements. So some ways to get in touch with me. You can always email me at nhyde@rosefieldrepaula.com, Nichole at CPA Tax Partners, or my cell phone. I'm always happy to answer questions and do discovery calls with people if they have questions about what's going on. This is a really confusing time for everyone, and it's really stressful for a lot of families and individuals, and we totally understand. And I can't really just stress the importance of working with skilled professionals in this area who understand how to navigate the complex Medicaid changes, the financial planning of what's going on, ways to structure tax planning so you're maximizing your assets working for you, but minimizing the tax liability, and who also understand just how to, navigate things like planned spending and how to help you get through these rough few months, with what you have. So I think, yeah, that's about it.
Okay, Nichole, thank you so much. We're going to move on to Rhonda. There are a lot of changes, and I think, after this session, we're going to send an email to everybody with everybody's contact info. If you want to reach anybody and you want to get into more detail, it's a lot of information. I know it's a lot of stuff going on, and there's a lot more stuff. And again, for your individual situations, we'll go through it. And with no further ado, Rhonda, take it away.
Okay, hi everybody. First of all, I want to thank Nichole and Arthur for their wonderful presentations. I myself learned a lot from them, and I can only imagine how everyone in the audience feels about all this great information. So thank you very much. I am a financial advisor. I've been a financial advisor for over a decade. My company is called The Quintessential Experience in Financial Services. And as you'll see from my presentation, I am passionate about what I do. My part of the presentation today is going to come down to two words: empowerment and positivity. Now more than ever, we have to think about our own mortality due to the economic climate and the COVID pandemic. And we have to realize that not having a plan takes a financial and emotional toll on those that we love. And in the end, the question will be, how do you want to be thought of? And you're the only one who can answer that question. And the way you can answer that question is by taking care of some important planning items. As Arthur mentioned, it's really important to make sure you have wills that are up to date, trusts if they make sense for your situation, and also advance directives. I want to add something to what Arthur was saying, that college students also should have healthcare proxies, especially those that are out of state. So although everybody is home now, it's important that your college-age students have a healthcare proxy. So if something were to happen to them when they're out of state, you can get important information regarding hospitalization and injuries that you would not be able to get if you didn't have a healthcare proxy for them. I also want to talk about the aspect of planning or not planning, which is called procrastination, and the reason people procrastinate. And there are very varied reasons. I see it many times in my own practice. Many times there's a fear of making a mistake. And other times people have had negative experiences when they've tried to plan. They felt that they weren't included in the planning process and they weren't being educated as they worked with professionals. And I'd like to encourage everybody to take a second look at planning and make up your mind that now is going to be the time that you're going to take care of these important items. And please be aware that everybody on the team here is on your side. We're here to educate you, we're here to get you going, and we're here to motivate you to do the right things for yourselves and your families. Now, if you are a breadwinner or a caretaker or a chief cook and bottle washer, whatever your title is, you need to do planning. You need to have the legal documents. You need to know that your applications and your statements and your accounts are all in one place, that someone who will be in charge, if you can't be in charge, i.e. your financial proxy, will be able to take over for you if you had become incapacitated and can't act for yourself. In the same way that you will have a healthcare proxy, you will have somebody that you will appoint to make decisions for you in case you cannot make those decisions. I don't know if you remember, years ago there was a store called Sims, and in their advertising they always had this tagline. They said an educated consumer was their best customer. Well, what we want to do today is make sure that you are educated and you are in the driver's seat and you will be the captain of your own ship. And what I mean by that is you're going to make a concerted effort after today to take the time to learn how to budget and save, how to plan for the expected and the unexpected via life insurance, disability, and long-term care insurance. And also, due to the current economic situation now, I'm also encouraging people to look into products that have guarantees with regard to retirement planning. So I'm going to take the discussion on to long-term care, and I'm going to take it in a different direction than Arthur did. What is long-term care that people are always talking about? Long-term care is custodial care that isn't covered by your health insurance. It actually, when it comes down to it, requires you as the consumer to need help with 2 of 6 activities of daily living. Activities of daily living are eating, bathing, dressing, toileting, transferring, and continence. And if you have a lack of ability to do any of these 2 activities of daily living, or one cognitive impairment, which could be Alzheimer's or dementia, that would trigger a long-term care claim if you happen to have long-term care insurance. So I'm sure you've noticed that what I'm telling you is slightly different than what Arthur was telling you, because it seems that Medicaid is getting very strict with their activities of daily living and what will trigger a claim. Now, let me give you an example of what this kind of care costs. So Genworth, which is a life insurance and long-term care company, has done a cost of care study in 2019. And they said that by the year 2030, which is only 10 years from now, 7 out of 10 baby boomers will be 65 and will require long-term care. And the average need for care is 3 years. That year, 2030, the average annual home care cost will be $79,178, and the annual assisted living cost will be $115,000, and I'm sorry, $115,444. So my question is, how are we going to pay for this care? Well, there are a few ways of taking care of this. I don't recommend it, but one of the ways you can pay for it is to use your entire pension, 401k, or life savings on care. Now, unfortunately, due to the current economic climate, many people have suffered tremendous losses in their retirement accounts and do not have the funds that they thought they would have to retire. And this is something we need to consider moving forward, that there seems to be corrections between 8 and 10 years apart. And as we get closer to retirement age, we need to make sure that the funds that we think will be there for us are going to be there for us. So another way that one can take care of these needs is to go and purchase a long-term care policy. A long-term care policy is a way of paying a premium every year for a certain amount of benefit that you will be able to access if you need 2 of 6 ADLs help or 1 cognitive impairment. And something that we should all be aware of is that long-term care, the care itself, is not necessarily limited to senior citizens. People who have accidents or have chronic illnesses may need this care at a much earlier date. Also, people who have been diagnosed with early dementia or Alzheimer's may also need this type of care at a much younger age and for a longer period of time. Just so you know, another way of taking care of this would be a permanent policy for life insurance with a rider. They also have the other riders, which will come into play if you have a terminal illness and need to access your policy early, if you need chronic care, as in long-term care services, and also if you happen to have a critical illness, such as cancer, heart attack, stroke, etc. These will cause you to be able to access the funds from your death benefit early in case some of these crises occur. Now, you'll note I'm talking a lot about things that may or may not happen. And the idea of planning is to prepare you and your families for things that are expected. All the good things that we look forward to: buying a house, going on vacation, sending kids to college, retiring, going on trips, spoiling those grandchildren when they come. We also need to be prepared at the same time for the unexpected. And this COVID pandemic has brought this subject up to our attention, that we really do need to sit down now and make some plans. So I'm calling on everybody out there in my Zoom audience today. My call to action is this: I'm asking you all not to get paralyzed, but to get proactive. I'm encouraging you not to procrastinate, but to make a plan. And I'm also going to encourage you to become more educated, which you've done today by tuning into our webinar. Don't listen to talking heads and financial entertainers on TV. Come to us. We are your legal, financial, and accounting experts, and we are going to be here to help you through this crisis and beyond. So please call on us. We're here to help, and we look forward to helping you and your families for many years to come. Thank you very much, everybody.
Thank you.
Thank you, Rhonda. I just want to add a couple little things. There's another new tax act that started in the beginning of the year prior to the pandemic that you need to know about. And I'm not going to put up the big screen and go into tremendous detail, but it's called the Secure Act. And the Secure Act did a lot of different things as far as a tax act. The biggest thing it did was it allowed you to take distributions later from your retirement plan, but it also got rid of this stretch IRA provision, which means that if you leave your IRAs or big investment assets behind, that they have to be distributed within 10 years, which can create a lot of taxation. Now, I can tell you factually that over 50% of the people that have large retirement assets don't go through them by the time they pass away. There's two things that happen. One, as Rhonda said, you could need long-term care. Long-term care, 70% of us are going to need some sort of care. And I have to tell you, the other 30% of us are going to have to take care of that 70%. So everyone is affected by that, not only financially, but also emotionally. And that you have to realize. Now, if you have to take money out of your retirement funds, what does that create, everybody? Taxes. Who said taxes? Exactly. So that's why a lot of your mics.
I know.
There
That's
you
why
go.
it's funny.
No, but it generates taxes. Now, if you leave it behind, your retirement assets behind, let's say to your children or to your spouse, that also generates taxes. Not little taxes, big taxes, because it's subject to both the state tax and income tax. So let's say I left my retirement, my 401k, let's say I had 200,000 or $1 million or whatever I had, and I left it to my kids, and they're 15 and 16 or 20. The government says you got to take it out over the next 10 years. Is that the time to screw up their tax bracket where they have to take that money out? Plus, it's subject to estate taxes. Now, a lot of you may not have done estate planning because you thought, okay, I'm in that exemption world of $5.5 million each. I'm here to tell you today that 2025, the exemption of $11 million for a couple goes away. It sunsets. And I'm also here to tell you today that next year, if there's any change in government, which, you know, there's always change in government, but they need to recoup taxes. And the first thing that everyone's looking at is the estate tax. They're going to take it, the exemption. They could go anywhere down to 3 million, 1.5 million, 1 million, okay? Also, New York State's going to need money. They can re-lower these things, and we anticipate that's the easiest thing to grab. okay, is the money left to your heirs. So if it's in a retirement vehicle and it's left to the heirs, not only that be taxed with estate tax, but then your heirs are going to pay the income tax on the distributions as well. So it could deplete the asset to almost 80% of the asset. So proper planning today is to use that money and spend that money. And if the intent is to leave it behind, use some of that money today to buy life insurance to protect your heirs down the road. You can schedule distributions inside a life insurance contract any way you like, and it's tax-free. Over a lifetime, over 20 years, when your kids hit 30, whatever you decide, and you can control that today with proper planning. You can't control it after you're gone. So that's something that you should be looking at and considering. Listen, the world is moving underneath our feet, but if we're not prepared while we're healthy or when we can, then when the next big wave hits, we're lost. And the big money grab comes in.
If I could say one quick thing, I think,
Sure.
Just to highlight that and to say, from my perspective, and I think from all of our perspectives, what everybody has to realize is that ultimately, a lot of the plans that were, even if you have a plan, even if you have some sort of financial estate plan, tax plan in place now, there are so many changes that have happened in the last 4 months, five months, basically, that almost all of those plans have to be tweaked because they were based upon laws and regulations that have either significantly already changed. And I'm with Neil on this. I think the estate tax and gift tax law is going to change both federally and New York State in the next 12 to 24 months. Has to. They got to recoup money, and that's going to be the easiest way they're going to do it. Doesn't matter who wins the election in 2020, they're going to lower the estate taxes exemption amount, and that means more people are going to pay, and more people are going to need to plan. And so, what does this all boil down to? Everybody's got to look at their plan, whatever it is, and realize it's got to change for a variety of reasons.
Now, 5 years from now, 10 years from now, hopefully the viruses will be gone, and you're going to be at a party, and you're going to be with some friends, you're going to be with some relatives, and maybe you're under a lot of stress right now. We're all under our own stresses, financially, emotionally. But you're going to be at a party, and you're going to be happy, and somebody's going to come up to you and say, you've changed. You're happy, you seem relaxed, you don't seem stressed. What happened? He says, well, I attended this Zoom seminar 5 years ago, and I met these people. And I got to tell you, they made a difference in my life. And you know what that friend or relative is going to tell you? They're going to say, well, I knew you 5 years ago. Why didn't you tell me? So you have the opportunity now, to tell your friends, to get with your parents, to get with your brothers and sisters and siblings, and say, hey, I'm making proactive steps now to plan for my future. I want you to talk to my friends. So please write down some names of some people that you know that we can help. And we're happy to consult with you. And again, we're going to follow this up with an email that's going to give you book times to speak to any of us at no cost. By the way,
Awesome.
Everybody's afraid to talk to an attorney. No cost.
$0.
Complimentary to review your situation. And if you want to meet with 2 of us, 3 of us, 1 of us, whoever you feel comfortable with, none of us, that's fine too. Hope you enjoyed today's session, and we hope to see you again soon. And I thank you. And again, if you have individual questions, there'll be our emails and our information. Please reach out to and ask us. Anything general in question right now, you're free to answer.
Thank you, Neil, Arthur, Rhonda, Nichole. Thank you so much.
You got it, Adam.
Thank you.
No problem.
Thank you.
Thank you. Have a great day, everyone.
Thank you.
Thank you.
Take care, Joe.
Stay healthy
You
and
too,
strong,
Rhonda.
everyone.
Stay healthy.
Be safe.